Alright, before we dive into the deep end, we have to get the important legal stuff out of the way. I am not a financial advisor, a loan officer, or an attorney. This video is for educational and informational purposes only. The information here is not, and should not be taken as financial, legal, or real estate advice. Your personal financial situation is unique, and the mortgage landscape changes constantly. So please, do yourself a favor and consult with qualified professionals before making any major financial decisions. Okay, with that said, let's pull back the curtain on one of the most stressful, confusing, and downright mysterious processes in modern American life. You found it. The one. The house with the perfect kitchen island, the backyard that doesn't stare directly into your neighbor's window, and that extra room you can finally turn into a home office. You can already see your life unfolding there. But there's a giant dark cloud hovering over this perfect dream. It's the mortgage, that single word that brings up feelings of dread, anxiety, and a million questions. The biggest one being, how long is this nightmare actually going to take? Am I going to be stuck in limbo for a month? 2 months? Will I even get approved at all? For most people, the home loan process feels like a total black box. You shovel a mountain of your most personal financial documents into a mysterious portal, and then you wait. You're hit with radio silence, broken only by a sudden frantic email demanding a document you've never even heard of, needed ASAP. It's a nerve-wracking journey where you feel completely out of control. Well, that ends today. The entire purpose of this video is to shatter that black box, turn on the lights, and hand you the GPS for your entire mortgage journey. We are going to walk through every single stage of the home loan approval process in the United States, from the second you decide to buy to the moment you get the keys in your hand. You will learn what's happening behind the scenes, why lenders ask for what they ask for, and most importantly, how you can take control and shave weeks, yes, I said weeks, off the typical timeline. So let's tackle the big question head on. How long does it take to get a home loan? The industry average from application to closing is anywhere from 30 to 60 days. Now, you might hear stories of people closing in 21 days, and you might hear horror stories of it dragging on for 90 days. The difference between the 21-day dream and the 90-day nightmare comes down to one thing: preparation and understanding the game. And the game starts long before you even find that perfect house. The first, and I mean the absolute most critical, non-negotiable first step in this entire process, is getting pre-approved. Not pre-qualified. Pre-approved. This is the single biggest mistake I see first-time homebuyers make. They treat these two terms like they're interchangeable, but they are worlds apart. Think of it this way. A pre-qualification is like telling your friend you think you can run a marathon. It's a guess. It's based on a quick, 10-minute phone call where you tell a lender your approximate income and your estimated credit score. They'll crunch some numbers and give you a ballpark figure of what you might be able to borrow. It's a conversation. It's an estimate. It's practically worthless when it comes time to make an offer. A pre-approval, on the other hand, is like actually running a 10K, getting your time officially clocked, and having a coach confirm you are physically ready for the full marathon. It's real. It's verified. For a pre-approval, you formally apply with a lender. You provide them with your pay stubs, your W-2s, your bank statements, your tax returns. You give them permission to pull your full, official credit report. A real human underwriter, the person who actually makes the decisions, reviews your entire financial profile and gives you a conditional commitment for a specific loan amount. That pre-approval letter is your golden ticket. It's the key that unlocks the entire home buying world. Why is it so powerful? 3 reasons. First, it tells you exactly what you can afford. This stops you from wasting months of your life falling in love with beautiful Zillow-perfect houses that are completely outside of your real budget. The pre-approval letter is your financial reality check. It gives you a hard price ceiling so you can shop with confidence and focus only on the homes that are actually within your reach. Second, it transforms you from a window shopper into a serious buyer in the eyes of real estate agents and sellers. Imagine a seller gets 2 offers on their house. One comes with a flimsy pre-qualification letter, a maybe. The other comes with a rock-solid pre-approval letter from a reputable lender, a verified, underwritten, almost guaranteed yes. Which offer do you think they're going to take more seriously? In a competitive market, an offer without a pre-approval letter is often thrown straight into the trash. It signals that you haven't done your homework, and that the deal has a high chance of falling apart later. And third, and this is crucial for our timeline, a strong pre-approval dramatically speeds up the final loan process. Why? Because you've already done 80% of the work up front. The lender has already verified your income, your assets, and your credit. When you finally find a house and get an offer accepted, the lender doesn't have to start from scratch. They just need to process the property details like the appraisal and title report, which we'll get to later. So, what do you actually need to get this golden ticket? Get ready to open up your financial life. The lender is essentially trying to answer 3 questions. Do you have a stable history of earning money? Do you have money saved? And do you have a good track record of paying your debts? To prove this, you'll typically need to provide your last 2 years of W-2s and federal tax returns. This shows your income history and its stability. If you're self-employed, get ready to provide 2 years of business returns and a profit and loss statement as well. Your most recent 30 days of pay stubs. This shows your current up-to-the-minute income. Your last 2 months of bank statements for all of your accounts, checking, savings, investment accounts. They are looking for your down payment funds and making sure you don't have any large, mysterious deposits that could be an undisclosed loan from a relative. And finally, you'll provide your social security number and consent for them to pull your credit. They'll look at your score, your payment history, and your debt-to-income ratio, which is just a fancy way of saying how much of your monthly income is already eaten up by other payments like car loans and credit cards. Now, gathering all of this might sound like a pain, and it can be. But here's the pro tip. Get all of these documents scanned and saved in a single folder on your computer before you even talk to a lender. When they ask for them, you can email them over in 5 minutes. This alone will make you look like the most organized, on-top-of-it borrower they've ever seen. So, how long does this all-important pre-approval stage take? If you have all your documents ready to go, you can often get a pre-approval letter in your hand in as little as 24 to 72 hours. If your finances are more complex or you're slow to provide documents, it could take a week or more. Once you have that pre-approval letter in your hand, you are officially in the game. You're no longer a spectator on the sidelines. You are a player on the field, ready to make a winning offer. And that's when the real hunt for a home begins. And the main closing clock really starts ticking. The next step from going under contract to the final underwriting is where most of the frustrating delays happen, but we are going to break down exactly how you can navigate it like a pro and stay in the driver's seat. So your offer was accepted. You feel that incredible rush of adrenaline, excitement, and maybe a little bit of terror. You've officially gone under contract. This is the moment the game truly begins. All that pre-approval work was just the warm-up lap. Now you're in the race and every single day counts. The first thing that happens, usually within hours of your offer being accepted, is your loan officer officially flips the switch on your loan application. They take your pre-approval file, which was based on preliminary information, and convert it into a live, active loan for that specific property. They'll plug in the sales price, the property address, the estimated taxes and insurance, and formally submit it into the lender's system. This is what triggers the entire machine to start moving. Your very first mission, and I mean you should do this the same day you go under contract, is to send a copy of that fully signed purchase agreement to your lender. Don't wait for your real estate agent to do it. Take a picture, scan it, whatever it takes, you send it yourself. Why? Because the lender cannot legally do anything. They can't order the appraisal, they can't send official disclosures until they have that signed contract in hand. Procrastinating on this for even one day can create a domino effect of delays down the line. Once they have that contract, get ready for the document avalanche. Your loan officer is now going to send you a list of updated documents they need. You might think, wait a minute, I already sent you everything for the pre-approval. And you're right, you did. But that was then, this is now. Lenders need the most recent information possible. They'll ask for your most recent pay stubs, usually covering the last 30 days. They'll want your most recent bank statements for all accounts you're using for the transaction, and they will scrutinize every single page. Yes, even the blank ones. If the statement says page 1 of 8, they need all 8 pages. If you send them 7, they will kick it back and you'll lose a day. And here's a critical pro tip that saves countless buyers from massive headaches. Large deposits. If you have any deposits on your bank statements that are not from your regular payroll, you must be able to source them. A $50 birthday check from your grandma? No one cares. But a random $5,000 deposit? The lender will stop everything and demand to know where that came from. They need to ensure you're not taking out a secret loan to cover your down payment, which would mess up your debt-to-income ratio. So if you sold a car, be ready with the bill of sale. If a family member gave you a gift, you'll need a signed gift letter and proof of the funds leaving their account and entering yours. The best strategy is to be proactive. As you're gathering your statements, look at them yourself. If you see a large, non-payroll deposit, Find the paperwork for it immediately and send it to your lender along with the statement. Don't wait for them to ask. This single act can shave days, even a week, off your processing time. You are essentially doing the processor's job for them, and they will love you for it. Simultaneously, within 3 business days of submitting your live application, federal law requires your lender to send you a package of initial disclosures. This is a thick stack of digital documents that can feel incredibly intimidating, but there are only a couple you need to focus on immediately. The most important document in this entire package is the loan estimate, or LE. The loan estimate is the official price tag for your mortgage. It breaks down your interest rate, your monthly payment, and most importantly, your estimated closing costs and the total cash you'll need to bring to the closing table. Review this document with a fine-toothed comb. Does the loan amount match the sales price minus your down payment? Is the interest rate what you discussed? Are the fees in line with what you expected? It can feel frustrating to get emails from a processor you've never spoken to asking for more and more paperwork, but you have to understand their perspective. They are following a very strict checklist, and their goal is to make the file so clean, so perfect, that when the underwriter sees it, they can approve it in minutes without asking a single question. A good processor is your best friend in this journey. Respond to their requests within minutes, not hours or days. Give them exactly what they ask for. If you do this, you'll fly through processing. If you drag your feet, your file will keep getting pushed to the bottom of their pile, and you'll be the one stressing out as your closing date gets closer and closer. So let's recap this critical stage. In the first week or two after going under contract, you've submitted your live application, provided a mountain of updated documents, signed your initial disclosures, and kicked off the appraisal process. Your loan processor is now working behind the scenes, assembling every piece of the puzzle. The clock is ticking, the appraisal is pending, and every document has been gathered and verified. The processor organizes everything into a pristine digital file, attaches a cover sheet, and with a click of a button, sends it off into the queue. It is now officially heading for the most critical judgment of its life. The file is now waiting for the one person who holds the ultimate power to approve or deny your dream of homeownership, the underwriter. And what happens in that underwriting black box is what we're diving into next. The underwriter is not a faceless villain or an unfeeling algorithm. They are a highly trained, specialized financial detective. Their one and only job is to protect the lender from making a bad investment. And to them, your loan is an investment. They are the last line of defense for the bank's money. They don't know you, they don't know your story, and frankly, they don't care about your dream kitchen or the great school district. They care about one thing and one thing only: risk. Their entire process is designed to answer a single multi-$100,000 question. What is the probability that this person will pay this money back on time every time for the next 30 years? To answer that question, they don't use a crystal ball. They use a time-tested, industry-standard framework. You may have heard of it as the 3 C's, but in reality, it's the 4 C's of underwriting. And understanding these 4 pillars is the key to unlocking the entire logic of the loan approval process. Those 4 C's are capacity, credit, capital, and collateral. Let's break down exactly what the underwriter is looking for in each. First, and arguably most important, is capacity. This is the simplest C to understand. It just means, can you actually afford the monthly payment? Do you have the capacity to repay the loan? The primary tool the underwriter uses to measure this is your debt-to-income ratio, or DTI. It's a simple piece of math that has a massive impact on your life. They take all of your monthly debt payments, your car loan, your student loans, your credit card minimum payments, plus the proposed new mortgage payment, which includes principal, interest, taxes, and insurance, and they divide that total by your gross monthly income, the money you make before any taxes are taken out. So let's imagine you make $8,000 a month before taxes. And let's say your car payment is $500, student loans are $300, and credit cards are $200. That's $1,000 in existing debt. Now let's add a new potential mortgage payment of, say, $2,500. Your total monthly debts would be $3,500. The underwriter divides that $3,500 by your $8,000 gross monthly income. The result is 0.4375, or a DTI of 43.75%. For most conventional loans, lenders want to see that DTI number stay below 45%, and ideally below 43%. Some government-backed loans like FHA might allow for a DTI over 50%, but that comes with other stringent requirements. If your DTI is too high, it sends up a giant red flag to the underwriter. It signals that you might be stretched too thin, and that any unexpected expense, a car repair, a medical bill, could put you on the path to missing a mortgage payment. To the underwriter, high DTI equals high risk. The second C is credit. This isn't about how much money you make. It's about your history and your character when it comes to borrowing money. Have you proven that you're a responsible borrower in the past? Your credit score is the headline, the quick summary. But the underwriter is a detective, remember? They read beyond the headline. They pull your full credit report and they read every single line. They're looking at the story your credit tells. They see that collection from a medical bill 3 years ago. They see the 30-day late payment on your car loan from 2019. They see that you maxed out 3 credit cards last Christmas. They also see that you've paid your student loans on time, every month for 7 years straight. They see that you have a long history with your oldest credit card. Each of these details is a clue. A single late payment 2 years ago might be overlooked if the rest of your history is perfect. But a pattern of late payments, even for small amounts, tells the underwriter a story of unreliability. A bankruptcy or foreclosure is a major plot twist that requires extensive explanation and a long waiting period. The underwriter is building a character profile. Are you the hero who always pays their debts? Or are you a risky protagonist with a history of financial trouble? Your credit report is your financial autobiography, and the underwriter reads every chapter. The third C is capital. In simple terms, how much of your own money are you bringing to the table? This is your down payment, your closing costs, and any money you'll have left over after the transaction is complete, which are called reserves. Capital is critically important to an underwriter for 2 reasons. First, it demonstrates your financial stability and your ability to save. It shows you're not living paycheck to paycheck. Second, and more cynically, it ensures you have skin in the game. If you put down 20% of your own money, you have a massive incentive to never miss a payment, because you don't want to lose your own hard-earned capital. The less money you put down, the less you have to lose, and the higher the statistical risk of default. This is why underwriters scrutinize your bank statements. They are verifying that you actually have the cash you claim to have. And more importantly, they are verifying where it came from. They're looking for large, unusual deposits. A random $10,000 deposit a month before you apply for a loan is a massive red flag. Was it a loan from a friend that you'll have to pay back? Is it mattress money that can't be sourced? Every dollar for your down payment and closing costs must have a paper trail. Pay stubs, tax returns, a gift letter from a relative with a copy of their bank statement showing the funds. To an underwriter, undocumented cash is untrustworthy cash. Finally, we have the fourth C, collateral. The underwriter isn't just approving you. They are approving the house. Remember, the house is the collateral for the loan. If you stop making payments, the bank takes the house to recoup its investment. So the underwriter has to be absolutely certain that the house is worth the price you're paying for it. How do they do that? Through the appraisal. The lender will order an independent, third-party appraisal. A licensed appraiser will visit the property, measure it, assess its condition, and compare it to similar, recently sold homes in the neighborhood. They will then generate a detailed report with their professional opinion of the property's fair market value. The underwriter reviews this report with a fine-tooth comb. They're checking to make sure the appraiser's logic is sound and the comps, the comparable sales, are truly comparable. If you've agreed to pay $400,000 for a house, but the appraisal says it's only worth $380,000, the deal comes to a screeching halt. The bank will not lend you more money than the asset is worth. The property itself must be a safe bet. So those are the 4 pillars: capacity, credit, capital, and collateral. But before your file even lands on a human underwriter's desk, it first faces a trial by fire in the digital world. It's run through what's called an automated underwriting system, or AUS. The 2 big ones are Fannie Mae's Desktop Underwriter, known as DU, and Freddie Mac's Loan Product Advisor, or LPA. This sophisticated software takes all your data, your income, debts, assets, credit score, loan amount, and runs it through thousands of algorithms based on decades of loan performance data. In seconds, it spits out a preliminary finding. The best result is approved/eligible. This means the computer sees your file as a strong, low-risk loan that meets all the guidelines. The middle ground is refer/eligible. This means the computer sees some potential issues or complexities and is referring the decision to a human for a closer look. The worst result is ineligible, which is a hard stop. Only after your file gets a passing grade from the AUS does it move on to the human underwriter. The human's job is to do what the computer can't: Use judgment and verify everything. The AUS approved your income based on the number your loan officer typed in. The human underwriter is going to look at your actual pay stubs and W-2s to make sure it's real. The AUS accepted the bank account balance you stated. The human is going to look at the statement to hunt for those weird deposits. They are the auditors. They are the fact checkers. After this exhaustive review, the underwriter will issue one of 3 decisions. The first and rarest on the first pass is a final approval or clear to close. This is the holy grail. It means you've met all the requirements and the loan is fully approved. The second, and by far the most common, decision is a conditional approval. This is not a denial. It's a yes, but it means the underwriter is willing to approve the loan if you can provide some additional documentation or clarification. These are called conditions. Common conditions include a letter of explanation for a recent credit inquiry, your most recent pay stub if a new pay period has passed, or an updated bank statement. Your loan processor will work with you to gather these items and resubmit them to the underwriter. The third decision is a denial. This is the one everyone fears. It means the underwriter has found an issue so significant that they cannot approve the loan under any circumstances. It could be a DTI that's just too high, a credit history that's too risky, or unverifiable income. For most people, the journey through underwriting isn't a simple pass or fail. It's a back-and-forth process. It's a negotiation between your loan team and that financial detective, the underwriter. You get that conditional approval, and now the clock is ticking. You are in the final stretch, but a new race has just begun. The race to clear those conditions. And navigating that final frantic sprint to get your clear to close is where things can get incredibly stressful. And it's exactly what we're breaking down next. So you've got your conditional loan approval. For a glorious 30 seconds, you feel like you've conquered Everest. You picture yourself on the front porch, keys in hand. But then you open the email attachment, and the feeling vanishes. Instead of a golden ticket, you're looking at a list of demands. A scavenger hunt designed by a meticulous, caffeine-fueled detective we call the underwriter. This list, my friends, is your prior-to-close conditions, and your new full-time job is to hunt down every last item on it. This is the phase where deals can and do fall apart. It's where timelines get vaporized. The average time to clear conditions can be anywhere from a few days to a few weeks, and the difference between the two almost always comes down to your speed, your organization, and your ability to not have a complete meltdown. Let's break down what you're actually looking at. Underwriting conditions fall into a few main categories. First, you have the simple updates. These are the easy ones. The underwriter has been working with your file for a week, maybe more. In that time, your documents have aged. So they'll ask for your most recent pay stub. They'll want your most recent bank statement. This is just to prove that in the 7 days since you first submitted your file, you didn't quit your job to become a professional street mime. This is housekeeping. You should be able to knock these out in an hour. Send them to your loan officer immediately. Don't wait until the end of the day. Do it now. Every hour counts. Next, you have the clarifications. This is where the detective work begins. The underwriter has spotted something that doesn't quite add up. It's not necessarily bad, it's just an unanswered question. The most common one, large non-payroll deposits. You know that $20,000 your parents graciously gifted you for the down payment? To you, it's a beautiful, life-changing gift. To an underwriter, it's a giant, flashing red light that says, undisclosed loan, or potential money laundering. They have no idea where it came from. So they'll put a condition on your approval. Source and season large deposit in checking account ending in 1234. What does that even mean? It means you have to prove with a paper trail so clean it squeaks exactly where that money came from and that it's a legitimate gift, not a loan you have to pay back. This means you need a signed gift letter from your parents, a legal document stating the money is a gift with no expectation of repayment. But it doesn't stop there. You'll also need to provide a copy of your parents' bank statement showing the money leaving their account, and a copy of your bank statement showing it arriving in yours. The numbers have to match. The dates have to line up. If your dad pulled the money from his savings, transferred it to his checking, and then wired it to you, the underwriter might want to see all 3 of those statements. They are building a bridge of evidence, and any missing plank can cause the whole thing to be rejected. This is where people get frustrated. Why do they need my parents' private information? Because federal regulations demand it. They are legally obligated to verify the source of all funds. Getting these documents can take a day, or it can take a week, depending on how tech-savvy your gift giver is. Another classic clarification is an inquiry on your credit report. Maybe you co-signed on your brother's car loan 5 years ago, and the underwriter wants proof that he's the one making the payments. You'll need to get 12 months of his bank statements showing the payments leaving his account. Good luck telling your brother you need a year of his private financial records by tomorrow. Or maybe there's a collection account from an old cable bill for $90 you didn't even know existed. You'll have to write what's called a letter of explanation, or LOX. This is literally a signed letter from you explaining the situation. To whom it may concern, regarding the collection from XYZ Cable Company, this was an error from when I moved in 2018. I have since paid the account and consider the matter closed. Simple, factual, and to the point. No emotion, no life story. The underwriter just needs something for the file that checks the box. Then we enter the most challenging category: the property and appraisal conditions. This is where the physical house itself comes into play. The appraiser went to the property and noted a few issues. Maybe a broken window in the garage, or a leaky faucet under the kitchen sink, or peeling paint on the exterior, which is a huge red flag for FHA and VA loans. The underwriter will not, under any circumstances, allow the loan to close until these issues are fixed. The condition will read: repair broken window in garage as noted in the appraisal report. Provide evidence of repair for final approval. Now, you don't even own the house yet. You have to coordinate with the seller through your real estate agents to get a contractor out to the property to make the repair. Who pays for it? That's a whole other negotiation. Once the repair is done, you can't just send a photo you took with your iPhone. You need to provide a paid invoice from the contractor, and in many cases, the lender will require the original appraiser to go back out to the property for a final inspection. That's another $150 or $200 out of your pocket, and it's subject to the appraiser's schedule. They might not be able to get out there for another 4 or 5 days. You are completely at the mercy of other people's schedules. A simple broken window can easily add a full week to your closing timeline. And finally, there's the wild card: the verification of employment, or VOE. Right before they give you the final clear to close, the lender will call your employer's HR department one last time. They have one question: does this person still work here? If the answer is yes, you're golden. But what if your HR person is on vacation? What if they just don't answer the phone? The lender will keep trying, but they will not fund your loan until they get that verbal confirmation. This last-minute check has torpedoed more closings than you can imagine, especially for people who decide to change jobs in the middle of buying a house. Pro tip: do not change anything about your financial life during this process. Don't buy a car, don't open a new credit card, and for the love of all that is holy, do not change jobs. So you're in the trenches. You're emailing documents, you're coordinating repairs, you're writing letters of explanation. Your loan officer is your quarterback, submitting each cleared condition to the underwriter as you get it. Sometimes the underwriter signs off on the first try. Other times they kick it back with another question. The gift letter wasn't signed. Please have the donor re-sign and date. Or, this bank statement is missing page 3 of 4. Please provide the complete statement. Can feel like a game of whack-a-mole. You solve one problem and another one pops up. The key is relentless, proactive communication. Be a document ninja. Have everything organized in digital folders, ready to deploy at a moment's notice. When your loan officer asks for something, your goal should be to get it back to them in under an hour. The people who drag their feet, who wait a day to find a pay stub or 2 days to ask their parents for a bank statement, those are the people whose closing dates get pushed back by weeks. After days or even weeks of this frantic back and forth, you'll submit the last document, the evidence for the final repair, the re-signed gift letter, and then silence. This is the final wait. Your file is back on the underwriter's desk for one last review. This can take a few hours or a full day, and it will be the longest day of your life. You'll check your email every 5 minutes. You'll jump every time your phone buzzes. And then it happens. An email pops up from your loan officer. The subject line just has 3 words. The 3 most beautiful words in the entire home buying process. Clear to close. It's done. The conditions are met. The underwriter is satisfied. The lender has officially, fully, and finally committed to giving you the money. You've survived the trial by fire. But you're not at the finish line just yet, because getting that clear to close triggers a whole new set of legal and financial clocks to start ticking, beginning with a critical document called the closing disclosure. This document is the final exam of your home buying journey. It's called the Closing Disclosure, or CD, and it's arguably the most important piece of paper you'll receive besides the deed to your house. Think of it as the ultimate itemized receipt for the biggest purchase of your life. But here's the crucial difference. You get this receipt before you pay. Federal law mandates it, and it's designed to protect you from last-minute surprises at the closing table. This wasn't always the case. Before 2015, the home buying world was a bit like the Wild West. You'd get an estimate of your costs at the beginning, and then you'd show up to closing, pen in hand, ready to sign, only to be ambushed by a completely different set of numbers. A fee you never heard of would magically appear. Your interest rate might be a fraction higher. The cash you thought you needed to bring suddenly ballooned by thousands of dollars. You were trapped. Your moving truck was already booked, your old lease was ending, and the sellers were staring you down. You had no choice but to sign. It was a nightmare scenario that played out for millions of Americans. Then came a piece of regulation that changed everything, often referred to as the TUR-ID rule. Its official name is the TILA-RESPA Integrated Disclosure Rule, but all you need to know is what it does for you. It forces the lender to give you the final locked-in numbers on this standardized, 5-page closing disclosure form at least 3 full business days before your scheduled closing date. Let me repeat that because it is the single most important timing element at this stage, 3 full business days. This isn't a suggestion, it's the law. And the clock starts when you receive the document, not when they send it. If they email it to you at 8 p.m. on a Monday, day 1 of your review period is Tuesday. Business days are also defined by law as Monday through Saturday, excluding federal holidays. So if you receive your CD on a Wednesday, your 3 days are Thursday, Friday, and Saturday. You could legally close on the following Monday. If you get it on a Thursday, your 3 days are Friday, Saturday, and the following Monday. You could close on Tuesday. This mandatory cooling-off period is your superpower. It gives you time to review every single line item, ask questions, and compare it to the initial loan estimate you received weeks ago, all without the pressure of a notary tapping their pen on the table. So, what are you looking for during these 3 days? Don't just glance at the final number. You need to be a detective. Grab your loan estimate, the document you got at the very beginning, and put it side by side with your new closing disclosure. First, look at page 1. This is the overview. Check the loan term, is it 30 years like you wanted? Check the loan type, is it a fixed rate? Or did an adjustable rate sneak in? Most importantly, stare down the interest rate and the monthly payment. Do they match what you were promised? They should be identical to your final locked rate. You'll also see a section for projected payments, which breaks down your total monthly obligation, the principal and interest, the homeowner's insurance, and the property taxes. This is your all-in cost of living in that house each month. Make sure it feels right. Now flip to page 2. This is the nitty-gritty, the detailed breakdown of all your closing costs. It's divided into sections. Loan costs are all the fees your lender is charging you. The origination fee, the application fee, the underwriting fee. These are fees that should not have changed much, if at all, from your loan estimate. There are very strict rules about how much these specific fees can increase. Then you have services you did not shop for, like the appraisal fee and the credit report fee. These can't change either. And then services you could shop for, like the title insurance and pest inspection. If you use the providers your lender recommended, these costs have a 10% tolerance for increases. If you chose your own, they can vary. Go through this list line by line. Do you see a processing fee, and an underwriting fee, and an admin fee? Question it. Ask your loan officer to explain what each one is for. Don't be shy. This is your money. Page 3 is where it all comes together in the calculating cash to close table. This is often the most confusing page, but it's just simple math. It starts with the total closing costs from page 2, adds your down payment, and then starts subtracting any credits. Did you put down an earnest money deposit? Gets subtracted here. Is the seller giving you a credit for repairs or to cover some of your closing costs? Gets subtracted here. Did your lender give you a credit? You'll see it here. The final number at the bottom of this table is the one that matters most for your immediate planning. It's the exact amount of money you need to have ready for closing day. This is the number you will be wiring from your bank account. So what happens if you find a mistake? A typo in your name, a fee that seems too high, a seller credit that's missing? You call your loan officer. Immediately. Do not wait. Most minor clerical errors can be corrected without delaying your closing. They can often fix the document and prepare a new one for you to sign at the closing itself. However, there are 3 specific major changes that will trigger a brand new 3-day review period. And this is where closings get delayed. First, if the APR, the annual percentage rate, which is your interest rate plus the lender fees, increases by more than 0.1% for a fixed-rate loan. Second, if a prepayment penalty is added to your loan, meaning you'd have to pay a fee if you pay off your mortgage too early. This is very rare today, but it's a big enough deal that the law requires a new waiting period. And third, if the basic loan product itself changes. For example, if you decide at the last minute to switch from a fixed-rate loan to an adjustable-rate loan. Any of these 3 events will reset the clock, and your closing will be pushed back by at least 3 more business days. This is why it is absolutely critical to have all your loan details finalized before that first closing disclosure goes out. Once you've reviewed the CD, you've compared it to your loan estimate, you've gotten answers to all your questions, and you've given your lender the thumbs up, you are truly in the home stretch. Your next and final major action item is arranging the wire transfer for your cash to close. And I need you to listen to me very carefully right now. This is the single most vulnerable moment for homebuyers, and it's where financial predators strike. You will receive wiring instructions from the title company or closing attorney. These instructions will tell you exactly where to send your down payment and closing costs. Scammers know this. They will monitor real estate transactions, and at the last minute, they will send you a fraudulent email. This email will look perfect. It will have the title company's logo. It will have the correct address of the property you're buying. It will use the name of your closing agent. It will look completely legitimate, but it will contain one tiny change. The bank account and routing number will be theirs, not the title company's. If you use those instructions to send your money, it will vanish into a scammer's offshore account, and it will be gone forever. Your life savings vaporized in an instant. So here is your non-negotiable rule. Before you ever initiate a wire transfer, you must verbally confirm the wiring instructions. Find the phone number for your title company or attorney from an independent source, like the first email they ever sent you, or their official website. Do not use the phone number in the email with the wiring instructions. Call them, speak to a human being you recognize, and read the account number and routing number back to them digit by digit. Have them confirm that it is 100% correct. Only then should you go to your bank to send the funds. This one phone call can be the difference between getting the keys to your new home and suffering a devastating, life-altering financial loss. Once that wire is sent and confirmed received by the title company, you've done it. You've cleared the final hurdle. The money is in place, the documents are correct, and all that's left is to show up, sign your name, and get your keys. And so you show up. You walk into the office of the title company or the real estate attorney, and the air feels different. It's quiet, professional, but underneath there's this electric hum of anticipation. This is the room where it happens. This is the closing table. For the past 30, 45, maybe even 60 days, this moment has been a theoretical destination, a distant point on a map. Now you're standing in it. You'll likely be greeted by your real estate agent, who is probably just as excited and nervous as you are. They've been your guide on this whole adventure, and this is their finish line too. Then you'll meet the closing agent, sometimes called an escrow officer or a settlement agent. This person is the master of ceremonies. They are a neutral third party whose entire job is to make sure every I is dotted, every T is crossed, and every dollar goes exactly where it's supposed to go. They work for the title company, not for you, not for the seller, and not for the lender. They work for the integrity of the transaction itself. Depending on the state and the specific circumstances, the seller might be there, along with their agent. Sometimes buyers and sellers have separate closing times to keep things simple, but often, you're all in the same room. It can be a little awkward sitting across from the people whose home you're about to own. You make small talk about the weather or the traffic, but everyone knows why you're really there. You're there to perform the final, legally binding ritual that transfers ownership of a piece of the earth from them to you. The closing agent will slide a stack of documents in front of you that looks like a small-town phone book. It's intimidating. It's probably the single largest stack of paper you will ever be asked to sign in your life. Your heart might start pounding a little faster. This is the point of no return. But don't panic. We're going to walk through the big ones, the ones that really matter, so you know what you're looking at. First, you'll see another copy of that closing disclosure, the CD. You've already seen a preliminary version of this, but this is the final version. The one that's going into the official record. You'll be asked to look it over one last time. This is your last chance to confirm that the numbers are what you expected. The loan amount, the interest rate, your monthly payment, the cash to close amount you just wired. It should all be familiar. Sign here. Initial here. Next comes the heavyweight champion of the stack, the promissory note. This document is deceptively simple. It's usually just a few pages long, but it carries immense power. This is your promise. It is the core of the loan. It's your personal, legally binding IOU to the lender. It says, I, your name, promise to pay the lender the sum of hundreds of thousands of dollars, plus interest over the next 360 months. When you sign this, you are personally guaranteeing the debt. If you were to default on the loan, this is the document that gives the lender the right to come after you for the money. It has nothing to do with the house itself. It's just about the debt. As you hold the pen over that signature line, you can almost feel the weight of it. It's a profound moment. You're not just buying a house. You're making the biggest financial promise of your life. Right after the promissory note comes its partner in crime, the mortgage, or in some states, the deed of trust. If the promissory note is the IOU, the mortgage is the or else. This is the document that connects the debt to the property. It's what makes this a secured loan. By signing the mortgage, you are giving the lender a security interest in your new home. You're saying, if I fail to keep the promise I made in the promissory note, you, the lender, have the right to take this house, sell it, and use the money to pay off my debt. This is the document that outlines the foreclosure process. It also contains all the rules you have to follow as the homeowner. You must maintain the property, you must pay your property taxes, you must keep it insured. This is the document that gives the lender the power to protect their investment, which for the next 30 years is also your home. Then somewhere in that stack you'll find the prize, the deed. This is the document of joy. While the note and mortgage are about what you owe, the deed is about what you own. This is the official document that transfers ownership from the seller to you. It will have the legal description of the property, not just the street address, but the specific lot, block, and plat map information that uniquely identifies your little piece of the world. The seller will have already signed this or will sign it in front of you. The closing agent will then take this document and have it officially recorded with the county. Once that deed is recorded, the public record will forever show that you are the rightful owner of that property. This is the whole point of the entire meeting. Beyond those big three, there will be a flurry of other papers. You'll sign a document about your impound/escrow account, confirming the amount being collected for taxes and insurance. You'll sign name affidavits, swearing that you are who you say you are, and that you don't have any outstanding judgments against you under a similar name. You'll sign a W-9 so the lender can report the mortgage interest you pay to the IRS. You'll sign disclosures you've already seen, like the initial loan application, just to confirm nothing has changed. Page after page, signature after signature, initial after initial. Your hand will start to cramp. Your signature will devolve from a respectable John Hancock into an illegible scribble. The closing agent will patiently point and say, sign here, initial here, date here, over and over again. Once your side of the stack is done, a quiet, tense moment often follows. The closing agent will gather up the key sign documents like the note and mortgage and scan them to your lender. This is where the term funding comes into play. The lender needs to perform one last, final review of the signed paperwork before they will release the money. They are making sure your signature is on every required line. They're doing one last verbal verification of employment, sometimes calling your boss while you are sitting at the closing table. They're checking to make sure no last-minute liens have been filed against you or the property. For a few minutes, which can feel like an eternity, everyone just sits there. You've signed away your life, but the deal isn't technically done. The seller doesn't have their money, and you don't have your keys. Then an email dings. The closing agent looks at their screen and smiles. We have funding approval, they'll say. The wire is on its way. This is the moment a collective sigh of relief fills the room. The lender has officially released the loan funds to the title company. The title company will then immediately pay off the seller's old mortgage, pay the real estate agents their commissions, pay themselves for their services, and pay the seller their net proceeds. The money is moving. The deal is done. And then it happens. The seller or their agent will slide a small clinking set of keys across the table. They're your keys. They might be on a simple metal ring or a tacky keychain left over from the previous owner, but they are the most beautiful keys you have ever seen. You pick them up. They feel heavy, substantial. This isn't just metal. This is the key to your front door, the key to your future, the key to your home. All the stress, the paperwork, the underwriting, the waiting, it all melts away in that one moment. You did it. You shake hands with everyone. There are smiles, congratulations, and a genuine sense of shared accomplishment. You walk out of that office, clutching your keys and a copy of your paperwork, and you step back out into the world. But the world looks a little different now, because somewhere in it, there's a house that is no longer just a house. It's yours. It's a feeling unlike any other. The weight of the keys in your hand is nothing compared to the weight lifted from your shoulders. The endless paperwork, the nail-biting underwriting, the final wire transfer. It's all in the rearview mirror. You did it. You stand on the porch of your new home. Maybe you run a hand along the door frame, and you take a deep, satisfying breath of air that somehow smells different. Smells like home. But after the initial wave of euphoria, after you've walked through every empty room and imagined where the couch will go, a new thought might start to creep in. It's a quiet question at first, but it grows a little louder. Wait a minute. What happens now? I mean, really, what happens next? I have this giant loan, the biggest debt of my life. Who do I actually pay? When is the first payment due? The lender I worked with for months, do I just send them a check? This is the part of the journey nobody really talks about. The finish line of closing day is actually the starting line of a 30-year marathon, and for a moment it can feel like you've been left at the starting line without a map. Let's clear that up right now. First, your first mortgage payment. You might assume it's due on the 1st of the very next month. If you closed on May 15th, you'd think your first payment is June 1st. But that's almost never the case. Remember all that paperwork you signed at closing? Tucked away in there was something called prepaid interest. You paid the interest on the loan for the remaining days of the month in which you closed. So, if you closed on May 15th, you paid the interest from May 15th through May 31st right there at the closing table. What this means is that your first official mortgage payment won't be due on June 1st. It will be due on July 1st. You get to skip a month, which is a fantastic financial cushion after the expensive process of closing. That July 1st payment will cover the interest for the entire month of June. Mortgages are paid in arrears, meaning you pay for the month that just passed, not the month ahead. So, you get a little breathing room. But who do you pay? This brings us to the single biggest point of confusion for new homeowners. Sometime in the first few weeks after you close, you're going to get a very official-looking piece of mail. It might be from the lender you worked with, the one whose name you know and trust. Or it might be from a company you have never ever heard of. Your heart might skip a beat. Is this a scam? Did something go wrong? No. Welcome to the world of mortgage servicing. Here's the secret. The institution that gave you the loan, the lender, is often not the same institution that will manage that loan for the next 30 years. The company that manages the loan, collects your payments, and handles your taxes and insurance is called the loan servicer. Think of it this way, the lender was like the car dealership that sold you the car. They helped you pick it out, negotiated the price, and handled the financing paperwork. The loan servicer is like the mechanic shop that will handle all your oil changes and maintenance for the life of the car. They are two different entities with two different jobs. Why does this happen? Because lending is a business of capital. Your original lender, let's say it was a local bank, doesn't want their money tied up in your single loan for 30 years. They want to take that money, sell your loan to a larger investor on the secondary market, like Fannie Mae or Freddie Mac, and then use that freed up capital to give another family a loan. It's how the entire mortgage market keeps moving. When your loan is sold, the new owner often hires a specialized company, the servicer, to manage it. So you might get a goodbye letter from your original lender and a hello letter from your new servicer. This letter, often called a welcome packet, is incredibly important. Do not throw it away. It will contain your new loan number, instructions on how to set up an online account, and details on where and how to make your payments. The most important thing to know is this. When your loan is sold to a new investor and assigned a new servicer, the terms of your loan, your interest rate, your monthly principal and interest payment, the total amount you owe cannot change. The deal you signed at the closing table is the deal you have for the life of the loan, regardless of who is collecting the payment. Now let's talk about that payment itself. When you open your first mortgage statement, you'll see it's not just one number. It's typically broken down into 4 parts, known by the acronym PITI. Principal, interest, taxes, and insurance. Principal is the portion of your payment that goes directly toward paying down the actual amount you borrowed. In the early years of your loan, this is a surprisingly small number. Interest is the cost of borrowing the money. This makes up the largest portion of your payment in the beginning. Over time, as you pay down the loan, the principal portion of your payment will grow, and the interest portion will shrink. This process is called amortization. The T&I taxes and insurance are the reason your total monthly payment might be higher than you expected if you only used a simple mortgage calculator online. This is your escrow account at work. Instead of you having to save up a huge chunk of money to pay your annual property tax bill and your yearly homeowner's insurance premium, the servicer does it for you. They estimate the total cost of your taxes and insurance for the upcoming year, divide it by 12, and add that amount to your monthly mortgage payment. They put this extra money into a special savings account called an escrow account. When those big bills come due, your servicer pays them for you on your behalf using the money from your escrow account. It's a forced savings plan, and honestly, it's a brilliant system. It prevents homeowners from being caught off guard by a multi-thousand-dollar tax bill they forgot to save for. So, your single monthly payment to the servicer covers everything. It pays down your loan, it pays the interest, and it saves for your taxes and insurance. It's a neat and tidy package. However, there's one more detail that can surprise homeowners a year into their journey. You might have a fixed-rate mortgage where the P&I, principal and interest, are locked in for 30 years. But that doesn't mean your total monthly payment will never change. Why? Because the T&I taxes and insurance can and will change. Your local government can raise property taxes. Your insurance company can raise your premium. Once a year, your servicer will conduct something called an escrow analysis. They'll look at what they actually paid for your taxes and insurance over the last year and project what they'll cost for the next year. If your taxes or insurance went up, your escrow account will have a shortfall. Not only will your monthly payment increase to cover the higher costs going forward, but it might also be temporarily increased a little extra to make up for the previous year's shortfall. Conversely, if your taxes or insurance went down, you might even get a check back from your servicer for the overage. Understanding this process is the key to true financial peace of mind as a homeowner. It's about knowing that your loan is safe even if it's sold, understanding where every dollar of your payment is going, and not being panicked when you get a notice that your payment is changing slightly a year from now. You're no longer just a buyer. You're a long-term manager of your greatest asset. You've conquered the approval process. Now you're ready to master the art of ownership. But that feeling of mastery can be a dangerous thing. Because between the moment you get that beautiful, glorious, clear to close, and the moment your hand cramps up from signing your name 100 times at the closing table, there exists a perilous gray zone. A financial twilight zone where dream homes go to die. This is the period where more deals fall apart than almost any other stage. Why? Because buyers get comfortable. They think they've crossed the finish line when in reality they've just entered the final, most heavily mined stretch of the race. You see, that clear to close isn't an unconditional promise. It's a statement that says, based on the financial snapshot we took of you weeks ago, and assuming absolutely nothing changes, we are prepared to fund your loan. The underwriter, your lender, they don't just pack up your file and forget about you. Oh no, they keep watching. They perform what's called a soft pull on your credit just before funding. They make one last call to your employer. They are monitoring your file right up until the wire transfer is sent. Your only job in this period is to become the most boring, financially stable, and predictable person on the planet. Your goal is to be a statue. Don't move. Don't breathe. Don't change a thing. So let's talk about the 7 deadly sins of the pre-closing period. These are the surefire ways to snatch defeat from the jaws of victory and delay, or even destroy your home purchase. First, and this is the big one, do not make any major purchases. I know it's incredibly tempting. You're about to own a home. You're already picturing the perfect sectional sofa, the 85-inch television mounted on the wall, the brand new refrigerator that makes craft ice. Or maybe your old car is on its last legs and you figure, hey, I'm approved for a $500,000 mortgage. What's a $30,000 car loan? It's everything. That car loan is a dagger aimed at the heart of your debt-to-income ratio. Remember that DTI calculation we obsessed over? The one the underwriter signed off on? You just blew it up. A $500 a month car payment can be the difference between approved and denied. When your lender does that final credit check and sees a brand new auto loan and a $10,000 credit inquiry from the dealership, alarm bells don't just ring. The entire fire station shows up at your file. All forward momentum on your closing stops. The underwriter has to completely reevaluate your loan with the new debt. Best case scenario? Your closing is delayed by a week or more while they recalculate everything. Worst case? Your DTI is now too high. Loan denied. You lose the house because you couldn't wait 2 weeks to buy a car. Don't do it. Use your old, beat-up furniture for a month. It'll make the new stuff feel that much better when you buy it after you have the keys. The second deadly sin. Do not change or quit your job. This sounds like common sense, but you would be shocked how often it happens. People get a better offer, or they get fed up with their boss and they think, I'll just start the new job after we close. Your lender will perform what's called a final verbal verification of employment, usually 24 to 48 hours before closing. They will literally call the HR department of the employer you listed on your application and ask, does John Doe still work here? Is he still in the same position at the same rate of pay? If the answer is who? Oh, he quit last Tuesday. Your loan is dead on the table. It's over. A change in employment, even for a higher paying job in the same field, is a material change that sends your file right back to underwriting. You'll need to provide offer letters, and likely your first new pay stub, which could take weeks. You have to be stable and predictable. Your job is the foundation of the entire loan. Don't touch the foundation. Third on our list, don't open, close, or max out credit accounts. Just leave your credit profile alone. Don't apply for that new credit card at Home Depot to get 10% off paint. That application creates a hard inquiry on your credit report, which can ding your score. The lender will see it and demand a letter of explanation. It's another delay. And don't close old credit card accounts either, even if you don't use them. A huge part of your credit score is the average age of your accounts and your credit utilization ratio. Closing an old account can actually make your score go down. And for heaven's sake, don't suddenly max out the cards you have. A high credit utilization ratio signals financial distress to a lender, and it can tank your FICO score overnight. If your score drops below the minimum required for your loan program, the deal is off. The fourth sin is a sneaky one. Don't make large, undocumented cash deposits into your bank account. We all know that lenders scrutinize your bank statements. They want to see where your down payment and closing costs are coming from. If, in the final weeks, a random deposit for $7,000 appears in your checking account, the underwriter will demand to know its source. They need to prove it's not a secret, undisclosed loan from a relative that you have to pay back. If you sold your old car for cash, you need a bill of sale and a copy of the title transfer. If it was a gift, you need a formal gift letter from the donor and proof of their ability to give the gift. Just depositing a pile of mattress money is a gigantic red flag for money laundering and will halt your closing until every single dollar is sourced and documented. Keep your bank accounts boring. Payroll deposits in, regular bills out. Nothing else. Number 5 is simple but crucial. Don't pay any bills late. Your entire loan approval is built on the idea that you are a responsible borrower who pays their debts on time. If a late payment on a credit card or car loan hits your credit report in the final days, it can be catastrophic. It can drop your credit score just enough to push you out of the approved range, and it tells the underwriter that you might be under financial stress. Set everything to autopay. Be vigilant. Don't let a simple mistake cost you your dream home. The sixth sin. Don't co-sign a loan for anyone else. Not for your cousin who needs a car, not for your kid who needs a student loan. When you co-sign, you are not just a backup payer in the eyes of the law. You are 100% responsible for that debt. Your mortgage lender will treat that entire loan payment as your own personal liability, even if you never make a single payment on it. It goes directly into your debt-to-income calculation, and it will almost certainly disqualify you. Just say no. You can be the hero for your family after you own your home. And the seventh, final deadly sin. Don't ignore your loan officer or processor. Stay in constant communication. In these final days, last-minute requests are common. The title company might need a clarification on your name, or the underwriter might have one final, nagging question about a bank statement. If you go dark, if you don't answer calls or emails for a day or two because you're busy packing, you could be delaying your own closing. People are working behind the scenes to get your loan funded. Be available. Be responsive. Help them help you get to the finish line. If you can avoid these 7 sins, if you can become a financial ghost for a few weeks, you will navigate this treacherous period successfully. But there is one final active step you must take before you sign your life away. The final walkthrough. This usually happens 24 hours before closing. This is not another inspection. This is your last chance to confirm 2 critical things. 1, that the property is in the same condition it was in when you agreed to buy it. And 2, that any repairs the seller agreed to make in the inspection negotiations have actually been completed. You'll walk through the house room by room. You'll flush the toilets, run the faucets, turn on the lights, and test the appliances. You'll check the walls for any new dings or scratches from the seller moving out. You'll bring your contract and the repair addendum with you, and you will physically verify that the leaky faucet was fixed and the broken window was replaced. If something is wrong, if the seller's punched a hole in the wall moving their couch, or if the agreed-upon repairs aren't done, you address it immediately before you go to closing. Once you sign those papers, that house and all its problems are yours. So you've navigated the minefield. You've avoided the financial sins. You've done your final walkthrough and the house is perfect. The wire has been sent from the lender to the title company. All that's left is a conference room, a notary public, and a stack of paper so thick it could stop a bullet. You're ready. It's time to go to closing. This is the moment. The culmination of every phone call, every email, every document you've uploaded at 2 in the morning. It's the grand finale of a marathon you didn't even know you were training for. You walk into the office of the title company or closing attorney, and the air feels different. It's quiet, professional, a little sterile. There's a conference room with a long, polished table that reflects the overhead lights. This is the arena. Your real estate agent is probably already there, a reassuring smile on their face. They've been your guide through the wilderness, and now they're here to see you cross the finish line. Seated at the head of the table is the closing agent, also known as an escrow officer or closing attorney, depending on your state. Think of this person as the neutral third-party referee for the biggest financial transaction of your life. Their job isn't to represent you or the seller. Their job is to execute the contract flawlessly, to make sure every I is dotted, every T is crossed, and every dollar goes exactly where it's supposed to. They are the calm, steady hand in this final hour. Sometimes the sellers and their agent will be in the room with you. A slightly awkward but amicable meeting of two parties about to exchange a massive asset. Other times it's a split closing, where they sign at a different time or in a different room. Either way, the focus is on you and the formidable stack of documents sitting in the middle of the table. It's not an exaggeration. It's a literal mountain of paper, an inch or two thick, held together by a binder clip that looks like it's straining for its life. Your first thought might be, I have to read all of this? The short answer is no, not word for word. The long answer is that you need to understand exactly what you're signing, and we're going to focus on the titans, the absolute most important documents in that stack. The closing agent will guide you, but your power comes from knowing what to look for before your pen ever touches the paper. The first document they'll likely have you review is an old friend, the Final Closing Disclosure or CD. You saw a preliminary version of this 3 days ago. This is the final locked-in version. This is your last chance to be the auditor. Your eyes should immediately scan for the big numbers. Is the loan amount what you expected? Is the interest rate exactly what you locked in? Is the cash to close figure at the bottom of page 1 the exact amount of money you wired? 99% of the time it's perfect. But you are your own best advocate, and this is your final opportunity to raise a flag if something looks off. Don't be shy. It's your money. Once you've confirmed the numbers, you'll encounter the first of the 2 most powerful documents you will ever sign. The first is the promissory note. This one is deceptively simple. It's usually just a few pages long. But don't let its size fool you. This document is the heart of the entire loan. This is your promise. It is your personal IOU to the lender for hundreds of thousands of dollars. It states the total amount you're borrowing, the interest rate, your monthly payment amount, and where and when you need to send the payments. When you sign this, you are making a legally binding promise to repay this debt. There's no house attached to this document. It is purely the promise itself. It's a moment of profound financial gravity. Right after the promise comes the consequence. The second heavyweight document is either the mortgage or the deed of trust. Which one you sign depends entirely on the state you're in. While they function similarly, they are legally different, but their purpose is the same: to secure the loan. This is the document that says, if I break the promise I made in the promissory note, the lender has the right to take this property back through a process called foreclosure. This is what makes it a mortgage loan, and not just a giant personal loan. It's the document that officially ties the debt to the physical property. It's the lender's security, their collateral. It's the or else to the promissory notes, I promise. Signing it feels heavy, but it's the key that unlocks the whole deal. After those 2 giants, you'll start moving more quickly. You'll sign documents for your escrow account, confirming you understand that a portion of your monthly payment will be set aside for property taxes and homeowners insurance. You'll sign a W-9 to confirm your social security number for tax purposes. You'll sign name affidavits confirming that you are who you say you are, and that all the variations of your name, with or without a middle initial for instance, all refer to you, the borrower. Page after page, the closing agent will give you a brief one-sentence summary. This one just says you'll pay on time. This one is your first payment letter, telling you when your first payment is due. This one says you'll use the property as your primary residence. Your signature will start to feel like an abstract scribble. Your hand will begin to cramp. This is affectionately known as signer's fatigue. You'll initial here, sign there, date here. It becomes a rhythm. For about 45 minutes to an hour, this is your world. The rustle of paper, the click of a pen, the calm voice of the closing agent. And then you'll come to it. The final, most satisfying document of all, the deed. This might be called a warranty deed or a special warranty deed. Unlike the mortgage or deed of trust, this document isn't about the loan. It's about ownership. This is the legal instrument that officially transfers the title of the property from the seller to you. As you sign this and as the seller signs it, the torch is passed. Ownership is conveyed. This is the piece of paper that, once recorded with the county, declares to the entire world that this house is your house. Finally, the stack is conquered. The last page is signed. You push the pile of paper back toward the closing agent, and a wave of relief washes over you. Your agent gives you a congratulatory pat on the back. The closing agent neatly organizes the signed documents into separate packages for you, the lender and the seller. You've done it. The ink is dry. The deal is signed. You lean back in your chair, ready for the keys, ready to walk out that door and into your new life. But as the closing agent offers a polite smile, you realize they aren't handing anything over just yet. The signing is complete, yes, but the closing isn't actually finished. There is one final critical step that has to happen behind the scenes, a step that no one in the room has any control over. And until that step is complete, the house still isn't legally yours, and those keys can't touch your hand. This final mysterious step is called funding and recording, and it's the true finish line of this entire marathon. You see, all those documents you just signed at the closing table, they're not just put into a filing cabinet. They are immediately packaged up and securely sent back to the lender's headquarters. There, a specialist known as a funder performs one last meticulous review. They are the final gatekeeper. They scan every page, looking for any missed signatures, incorrect dates, or notary errors. They're ensuring that the loan package is legally perfect and ready to be sold on the secondary market if the lender chooses. If the funder finds a mistake, everything comes to a screeching halt. Your phone will ring. It'll be your loan officer or the title agent saying, "We need you to come back and re-sign page 47. It's frustrating, but it's absolutely critical. Once the funder gives their final blessing on the paperwork, they authorize the wire transfer. This is the moment the lender officially sends the hundreds of thousands of dollars for your loan from their bank account to the title or escrow company's secure trust account. This isn't like a Venmo payment. It's a federal wire transfer that can take a few hours to process and be confirmed. This is why the timing of your closing matters so much. If you sign your final papers at 4 p.m. on a Friday, the funding might not actually happen until Monday morning. You've signed, but the money hasn't moved. The deal isn't done. But even when the wire hits the title company's account, the house still isn't yours. The title company now has the lender's money, and they have the check you brought for your down payment and closing costs. They have all the money. Now they need to make the ownership change official in the eyes of the law. This is the recording part of funding and recording. A representative from the title company, often called a courier, takes the most important documents from your file, specifically the deed of trust, which secures the lender's interest, and the grant deed, which officially transfers the property from the seller to you, and physically drives them or electronically files them with the county recorder's office. At the county office, a clerk takes your documents, stamps them with the date and time, and officially enters the transaction into the public record. This is the precise legal moment of transfer. It is the instant that the seller no longer owns the property, and you do. It's not when you signed. It's not when the money was wired. It's when that county clerk stamps your deed. That's it. That's the moment. Only after the title company receives confirmation from the county that the deed has been recorded, a confirmation that can come via email, a phone call, or a digital receipt, are they legally allowed to do two things: disperse all the funds to the appropriate parties, like paying off the seller's old mortgage and paying the real estate agents, and most importantly for you, authorize the release of the keys. This is why your real estate agent, who has been sitting with you through this whole process, can't just hand you the keys at the closing table. They have to wait for that magical call from the title company. The call that simply says, "We're on record." When that call comes, it's a wave of relief and excitement unlike any other. It's the culmination of every document you've hunted down, every form you've signed, and every sleepless night you've had. So let's zoom out and finally answer the big question. How long does the home loan approval process actually take? The pre-approval, as we discussed, is fast. Typically 24 to 72 hours. That's your ticket to the game. The house hunting, that's the wild card. It can take a week or it can take a year. But the core process, the timeline from getting your offer accepted to getting those keys in your hand, generally falls into a 30 to 45-day window. This is the industry standard. 30 days is considered a quick closing. 45 days is a more comfortable average pace. If there are complications, a low appraisal, title issues, or problems with your documentation, it can easily stretch to 60 days or more. Let's break down a typical 45-day timeline. Week 1 is all about initiation. You submit your formal application, receive and sign your initial loan disclosures, and pay for the appraisal. Your loan officer is ordering the appraisal, the title search, and setting up your file. Weeks 2 and 3 are the heart of the process. Underwriting. This is the long wait. Your file is in the underwriter's queue. They perform their initial review and issue that conditional approval. Your processor then works with you to gather all the necessary documents to clear those conditions. This back and forth is what consumes the most time. Week 4 is about finalization. You've submitted all your documents. The file goes back to the underwriter for a final review. The appraisal has come in and been approved. And then you get the 3 most beautiful words in the mortgage industry: clear to close. Your closing date is scheduled, and you get your final closing disclosure. And the final few days are for closing, signing, funding, and recording. This final step can take anywhere from a few hours to 2 business days, depending on the time of day you close and your county's recording process. So why does it take so long? It feels like it's just paperwork, right? But it's not. It's a carefully constructed system of checks and balances designed to protect everyone involved in what is a massive financial transaction. It protects the lender. They are about to loan you hundreds of thousands of dollars for 30 years. They have a duty to their investors and regulators to prove, beyond a shadow of a doubt, that you have the ability to repay that loan, and that the property they're securing it against is actually worth the money. It also protects you. The title search ensures you're not buying a house with a hidden lien from a long-lost relative or an unpaid contractor. The appraisal protects you from drastically overpaying for a property. Every step, while tedious, is a layer of security for your investment. And it protects the integrity of the entire system of property ownership in the United States by ensuring that every transfer of real estate is documented, verified, and made a matter of public record. Now, after all of that, how can you make your process fall on the faster end of that 30 to 45-day spectrum? Here are 4 crucial tips. First, prepare for the document gauntlet before you even apply. Create a digital folder on your computer. Scan and save the last 2 years of your W-2s and tax returns, the last 2 months of your bank statements for all accounts, the last 30 days of your pay stubs. Have it all ready. When your loan officer asks for these items, you can email them in 5 minutes, not spend 5 days hunting for them. This alone can shave a week off your timeline. Second, take a vow of financial silence. From the moment you apply for that loan until the moment the deed is recorded, do not change anything about your financial profile. Do not buy a new car. Do not co-sign a loan for your cousin. Do not quit your job to start your dream business. Do not deposit large amounts of cash that you can't source. And for the love of all that is holy, do not open new credit cards to buy furniture for the new house. The underwriter will run a final credit check just before funding. And if anything has changed, it can delay or even kill your entire deal at the last second. Third, become the most responsive person on earth. Treat every email and phone call from your loan officer, processor, or title agent with the urgency of a 911 call. If they need a document, send it immediately. If they have a question, answer it thoroughly. A one-day delay on your part doesn't just cause a one-day delay in the process. It means your file goes to the back of the underwriter's queue, which can turn your one-day delay into a 3 or 4-day setback. And finally, choose your team wisely. A fantastic, experienced loan officer and a top-notch real estate agent are not commodities. They are your guides, your advocates, and your problem solvers. They've seen it all. They know how to anticipate underwriting issues, how to structure a file correctly, and how to communicate effectively to keep things moving. Don't just go with the first person you find online. Ask for referrals from friends and family. Read reviews. An all-star team can be the single biggest difference between a smooth 30-day closing and a stressful 60-day nightmare. The journey to homeownership is a marathon. It's complicated, it's invasive, and at times it will test your patience. But understanding the roadmap, knowing what's coming next, and being prepared can transform that anxiety into confidence. And when you finally get that call that says you're on record, and you drive over to the house and the agent hands you a cold, solid set of keys, you'll feel the weight of every one of those 45 days melt away. And as you put that key in the lock and step across the threshold for the first time, not as a visitor, but as the owner, you'll know that every single signature, every document, and every anxious moment was absolutely worth it.